portion of this information in an aggregate form be made available. The annual public summary, at the very least, should provide general aggregate information, such as total number of multinationals that filed the form, and for each country with at least 3 U.S. multinationals, so we know what's happening in each of these tax havens in particular. The total number of U.S. multinationals operating in those countries, the total number of employees, total number of revenue, total amount of revenues, the profits or losses that are being accumulated there, the capital investments, and whether or not taxes are being paid in these jurisdictions.
Thank you for your comments.
Thanks.
Our next speaker is with the National Foreign Trade Council.
That's me.
Okay, so I have Catherine Schultz listed, so. Okay.
I'm Lou Greenwald, speaking on behalf of the National Foreign Trade Council. I'm here with Kathy Schultz of the National Foreign Trade Council and my colleague, Lucas Giardelli. On behalf of the National Foreign Trade Council, we'd like to express our appreciation to you, Melinda, Jeff, Brian, for allowing us to testify today regarding the recently issued C-by-C proposed regs. We have 5 topics of discussion: the effective date, the filing deadline, persons required to file and the national security exception, the reporting of fiscally transparent entities, territorial tax regimes, and the definition of tax residency. As you know, the proposed regs would apply for taxable years of the parent entity of a U.S. multinational that begins on or after the date of the publication of the final regulations. If the proposed regs are finalized in 2016 as expected, the first filing year for calendar year U.S. companies will be the 2017 taxable year, and the first U.S. C-by-C report for such companies will be due by September 17, 2018. However, as you also know, several foreign jurisdictions have already implemented C-by-C reporting effective for taxable years beginning on or after January 1, 2016, in line with the timeline recommended by the OECD. Further, many of those foreign C-by-C reporting regimes include the OECD recommended secondary reporting rule, under which a subsidiary may have an obligation to file a C-by-C report when the ultimate parent is not required to file in its jurisdiction. In our mind, it is reasonable to assume that the OECD's secondary reporting rule was not intended to apply when the parent's jurisdiction has merely taken longer to implement the requirement than the OECD's recommended timeline. Indeed, jurisdictions such as Australia have already indicated that they will grant an exemption for the first year of reporting if a parent jurisdiction has not yet implemented its C-by-C reporting regime. However, other jurisdictions may not provide such similar relief. In light of these concerns, we respectfully request that the IRS allow taxpayers to make an election to file C-by-C reports for the 2016 gap year. And we would certainly be willing and able to assist the IRS in implementing a 2016 gap year report. The filing deadline. The OECD had recommended that companies be given a year after the end of their fiscal year to file C-by-C reports. As you know, the proposed regs provide that the C-by-C report will be filed with the parent entity's timely filed income tax return with extensions. As such, for a calendar year taxpayer, the C-by-C report would need to be filed at the latest by September 15th rather than December 31, as recommended by the OECD. This poses a logistical and practical problem for companies that were intending to use their statutory accounts to prepare their C-by-C reports, which will likely not be available 9 months after the close of the taxable year. As such, we respectfully request that the IRS consider extending the filing deadline to December 31, even if that may require allowing taxpayers to file their C-by-C report separate and apart from their income tax return. Persons required to file. Again, as you know, the proposed regs generally require a U.S. business entity that is the ultimate parent of a U.S. multinational to file a C-by-C report if the multinational has revenues of $850 million or more for the preceding annual accounting year. Generally, an ultimate parent of a U.S. multinational is a U.S. business entity that controls a group of business entities, at least one of which is organized or tax resident outside the United States, that are required to consolidate their accounts for financial reporting purposes under U.S. GAAP, or that would be required to consolidate their accounts if equity interests in the U.S. business entity were publicly traded on a U.S. exchange. As acknowledged in the preamble to the proposed regulations, we believe the definition needs to be further refined. In this respect, we respectfully request guidance be provided that clarifies that U.S. multinational groups do not include business entities that, although required to consolidate their accounts with the ultimate parent for GAAP or security purposes, are not majority owned by such ultimate parent. Fiscally transparent entities. We respectfully request that further guidance be issued regarding the C-by-C reporting with respect to fiscally transparent entities, including as how to report the employees of such entities, of whether cash remittances from such entities should be excluded from its owner parent's reported revenue. National security exception. The preamble to the proposed regs requests comments with respect to the procedures that a taxpayer should be required to follow in order to demonstrate a national security reason to receive an exception from filing some or all of the information required by the C-by-C report. Our members seek and support safeguard procedures for U.S. multinationals that demonstrate such a national security reason. Finally, tax residency and territorial tax regimes. As you know, there is some ambiguity around the meaning of tax jurisdiction of residence in the proposed regs. The proposed regs provide in the third sentence of proposed Reg section 1.6038, -4B6 that a business entity will not be considered a resident in a tax jurisdiction if such business entity is liable to tax in such jurisdiction solely with respect to income from sources in such tax jurisdiction or capital situated in such tax jurisdiction. This could be read to mean that subsidiaries resident in countries with territorial tax regimes, for example, Hong Kong, are considered not to have a tax jurisdiction of residence and as such are subject to reporting on an aggregate basis under the rule in proposed Reg-4D3 Romanet 1 for entities with no tax jurisdiction of residence. We respectfully request that the IRS confirm that the third sentence of -4B6 does not refer to jurisdictions that apply a territorial tax regime as a general matter to all taxpayers resident therein. Again, thank you very much for the opportunity to provide these comments.
Thank you.
Any questions? Thanks.
Thank you. Our next speaker is from the Financial Transparency Coalition, Porter McConnell.
Thanks to all three of you for inviting public testimony today and for having us here. My name is Porter McConnell, and I'm the director of something called the Financial Transparency Coalition, which is a global network of governments and nonprofit organizations and experts on 5 continents working together to curtail illicit financial flows. There are 4 key points I want to make today about the proposed rulemaking. First, country-by-country reporting will be more effective if it's public. Second, public country-by-country reporting is good for the economy and it reduces risk. Third, public country-by-country reporting already exists with support from the private sector. And finally, Other markets like the European Union and in the G20 are already committing to this measure. Okay, first one. To be effective, country-by-country reporting needs to be public. In a time with a lot of pressure on government spending, we know that it is hard sometimes to make the best use of resources that you have. Making country-by-country reports public increases the efficiency of your work. It would ensure that there are more eyes with valuable perspectives. It helps digest massive amounts of data filed by companies, and it would help flag any indications of risk to the authorities, in effect, crowdsourcing some of your work. Requiring for the information to be disclosed, the mere act of requiring it, also has an important deterrent effect, since presenting questionable numbers carries a reputational risk for companies. And that deterrent effect, it's important to note, is not available in the case of closed country-by-country reporting. Disclosing the information publicly would help researchers and experts better understand how companies are shifting large amounts of profits by using offshore secrecy jurisdictions. And that could inform future policy decisions. So for example, if it is determined that a majority of multinational companies operating in the US are deferring the taxes they incur indefinitely by shifting profits out of the US and into low-tax jurisdictions, this will have important implications for efforts to reform the US tax code. Finally, the public and authorities would have better means to detect corrupt activities, including, but certainly not limited to, trade mispricing and trade-based money laundering. Okay, so number 2, public country-by-country reporting is good for the economy and it reduces systemic risks. Discouraging aggressive tax planning and tax evasion is one of the main arguments for making CBCR public. Making it public would serve as a corrective to the global economy, so competition can center on delivering the best products and services for the most competitive rate, rather than who can hire the savviest tax planners to create the most complex of corporate structures to escape from paying taxes on profits. In our conversations with private sector leaders, many of them suggest that they would welcome the opportunity to spend less on lawyers and bankers and accountants and more on product development. Currently, multinational enterprises have an advantage over small and medium enterprises because they can engage in aggressive tax planning and jurisdiction shopping. Competition that's based on tax planning distorts the functioning of the market and breeds unnecessarily complex and opaque business structures. Creating and maintaining these complex structures is resource intensive, and it generates additional accounting and legal and advisory costs. However, many small and medium enterprises operate solely in the US, and they effectively publish their financial information on a country-level basis. It's not surprising then that a recent European Union impact assessment found that public CBCR would serve to level the playing field between transnationals and national companies. In addition to ensuring that multinationals would have to adhere to similar reporting requirements as our local small businesses, public CBCR would ease the market entry for new entrepreneurs. In other words, it would increase the competitiveness of the American economy and enable the next generation of innovators. This year's startup could become a sizable job creator 5 years from now if given the same chance. Third, public country-by-country reporting already exists with no detrimental effects on business and with considerable support from the private sector. So one of the arguments you hear is that it would be bad for business, it would be costly. We've actually found in places where it has been implemented that non-trivial additional costs to business are pretty limited, actually. Since 2015, all European banks have had to comply with public CBCR. This has not put them at a competitive disadvantage with their non-EU counterparts. And many have reported becoming profitable again after the Great Recession. You will be well aware of impending public reporting requirements in the US for the extractive industries from Section 1504 of the Dodd-Frank Act. Important to note that US-based Cosmos Energy, Norway State Oil, and UK-based Tullow Oil have already begun to disclose this information with no harm to their competitiveness. If, in fact, any comparative advantage does exist, US extractives companies already required to disclose this information might well note the advantage now held by other industries and would likely support harmonizing those regulations to create more of a level playing field. Over 30 countries have since adopted laws requiring public CBCR for extractives projects after Dodd-Frank. Among them are countries in the European Union, Canada, and Norway. And in fact, we have seen that private sector actors are increasingly expressing support for public CBCR. Representatives of HSBC and Barclays banks both voiced support for public CBCR in testimony to the European Parliament. Jane McCormick, who's KPMG head of tax for Europe, Middle East, and Africa, stated last year that public CBCR is inevitable, and KPMG is already taking the steps internally to implement those rules. Before the banks regulation in the European Union, PwC did a study for the European Commission on country-by-country reporting for banks, and it concluded, and I quote, "Publishing turnover, staff numbers, taxes paid, and subsidies received in every country banks operate in could boost competitiveness, increase lending, and bolster financial stability. It will fight tax evasion and not harm investment or result in excessive compliance costs for banks." This is PwC talking. We also commissioned an anonymous survey of FTSE 100 companies in the UK with our coalition member Christian Aid, and it revealed that a large majority of companies would not actively oppose the introduction of a legal requirement for them to make their CBCR reports public, while some would even actively support it. Investors are also a big constituency here. They look to minimize systemic risks in the financial system, and they see financial transparency measures as a tool to prevent the next big bubble. Some suggest that oil exploration loans might be the next bubble to burst, and they are right to be worried if massive losses can so easily be hidden offshore. We have heard from institutional investors like Eumedion in Europe that they support public CBCR because it allows shareholders the opportunity to do a bit more analysis and to have a conversation with their boards. Fourth point, other international markets like the European Union and some G20 nations are already committing to this measure. Just yesterday, at an anti-corruption summit held in London, 12 governments expressed their support for a global commitment to public CBCR. They are Afghanistan, Australia, France, Georgia, India, Italy, Mexico, the Netherlands, Nigeria, Russia, Spain, and the UK. As you know, last fall, the G20 agreed to recommendations from the OECD to implement a fairly weak country-by-country reporting standard that would be available only to the authorities. While the OECD standard, to our mind, is at best just a foundation, G20 nations represent over 80% of the world economy. India is already starting to implement. Others are soon following suit. Whether the US decides to implement this commitment fully and in multilateral partnership is crucial to its effectiveness, as you will hear from others today. EU countries have recently reached a political agreement to introduce OECD-style CBCR, and some of those reports will be coming this year. But it's important to note that the European Commission has proposed new rules to make some of that reporting public. With the momentum that was created by the Panama Papers, it's likely that this proposal will gain support, leading to increased public reporting for all, including American companies operating in the European market. Finally, public CBCR is an important vehicle for transparency in developing countries and whether financial activity happening there is actually benefiting citizens. This is especially true for the countries unable to participate in the confidential CBCR system being built by the OECD for its members. Accessing this information through public reports would give developing country governments the tools to mobilize more domestic resources, and those could be used in turn to invest in healthcare, education, roads, and all the critical public services that those of us here in the US sometimes take for granted. You'll hear a little more about this from others today as well. So thank you for the opportunity to share perspectives from civil society groups, governments, and experts on illicit financial flows from around the world, and I hope you'll take them into consideration.
Thank you.
Any questions, I should say? I guess I'm out of time.
Our next speaker is with the One campaign, Joseph Kraus.
On behalf of the One campaign, I would like to commend the U.S. Treasury Department and the IRS for moving quickly to implement the U.S.'s international commitment to address base erosion and profit shifting, an important issue that holds considerable impact for citizens, both in the U.S. and around the world. And thank you for the opportunity to appear before you today. My name is Joseph Kraus, and I am Senior Policy Manager on Transparency and Accountability at the One campaign. The One campaign is an international advocacy and campaigning organization of more than 7 million people. Roughly 2.5 million of those are here in the U.S., who are taking action to end extreme poverty and preventable disease in some of the world's poorest countries. With offices spread across 3 continents, we have seen firsthand the negative consequences of tax avoidance by multinational corporations, the scale of the problem, and the need for a global solution. Given the global nature of tax avoidance, it can be solved only by countries acting in concert, not by countries acting alone. That is why we strongly support the implementation of country-by-country reporting standards for multinational corporations that result in an effective global solution. To that end, I will focus my comments on two following areas in which we believe the proposed rule could be strengthened to maximize its effectiveness. First, country-by-country reporting should be publicly available, echoing some of the comments you've already heard today. And then second, the reporting threshold should be lowered so that more companies are covered. We believe that public disclosure of tax revenue is critical for enabling citizens to follow the money and ensure that taxes due are collected and spent appropriately. Profit shifting does not occur in a vacuum. Rather, it relies on a complex web of interconnected companies initiating intercompany transactions across multiple jurisdictions. As you well know, unraveling these complicated structures can require considerable time, resources, and international cooperation. We have great respect and admiration for the tireless and often thankless work carried out by the Treasury Department and the IRS, often while relying on restricted budgets. Yet this problem is too big to be effectively resolved by resource-constrained tax authorities acting alone. Thus, we see several significant advantages to requiring country-by-country reports to be accessible by the public. First, this would enable citizens, civil society, journalists, and government officials in both developing and developed countries to monitor the tax claims of multinational corporations. When citizens have access to this information and can better understand the tax agreements that their governments are entering into, they can hold governments accountable for negotiating fair terms and ensure that companies are paying all taxes owed. This could unlock much-needed funding for development in some of the world's poorest countries. Second, making this information public would save tax authorities the burden of processing numerous information sharing requests from abroad and may deter companies from evading taxes. Under the standard outlined in the proposed rule, tax authorities in developing countries would only be able to access this information under cumbersome information exchange agreements for which many poor countries are not well equipped, and then only if they have an established tax treaty with the U.S. This would prevent a significant number of countries from gaining access to information critical for ensuring that companies doing business in their countries are, in fact, paying the full taxes they actually owe. Third, country-by-country reporting provides investors with more comprehensive financial information about companies and helps them address investment risk more effectively. For this reason, investors with $10 trillion of assets under management have publicly supported the public disclosure of tax and other information in the extractive industries as part of the U.S.'s implementation of a provision in the Dodd-Frank Act. Furthermore, a large body of scholarly research concludes that increased accounting and tax disclosures can significantly decrease the cost of capital for firms with follow-on positive impacts for those firms' investors. There are clear indications of support for public CBCR in the business community. A recent poll of business leaders by PricewaterhouseCoopers found 59% in favor of the public disclosure of revenues, profits, and tax information on a country-by-country basis. As you've just heard, banks in the EU already disclose their country-by-country reports publicly under existing regulations, and a number of large banks, as well as some tax accountants and economists, have become vocal champions of the merits of public country-by-country reporting. In light of these clear benefits of public disclosure, it is troubling that the proposed rule suggests treating country-by-country reports as return information under 6103. As the proposed rule makes clear, Section 6103 imposes strict confidentiality rules with respect to all return information. This would preclude the ability of stakeholders beyond the IRS and Treasury to gain access to those documents now or in the future, even with the existence of a strong public case for doing so. The effective tax rates of corporations are a matter of public interest and therefore should not be shielded behind secrecy. The advantages of establishing and operating a corporation are many. Avoiding taxes and public scrutiny should not be among them. While, as is noted in the proposed rule, the information exchange agreements to which the U.S. is a party require the information exchange to be treated as confidential by both parties, this does not preclude the IRS or Treasury from requiring U.S. companies to make those reports public, or for the agencies to publish those reports themselves, since these will not have been received via information exchange agreements. The approach outlined in the proposed rule could also make it more challenging for the U.S. to align its country-by-country reporting regime with those of other jurisdictions or the international community in the future, should public disclosure become an established international standard. On this point, it is worth noting that the European Parliament has already approved public country-by-country reporting, and while the regulatory process in the EU is ongoing, this position has the support of a number of EU member states and a growing number of countries outside the EU, as you have just heard. There is already strong evidence that public access to country-by-country reports can be a game changer in exposing tax avoidance and altering the use of complex accounting structures to shift profits. A number of investigations by civil society organizations and investigative journalists have exposed the considerable lengths to which some multinational corporations have gone to avoid taxes. The fact that we are here today discussing this important problem and a proposed U.S. rule to address it is due in no small part to those efforts by committed citizens to shine a light into what has, for far too long, been a blind spot in the global economy. It would be a true disservice and a bitter irony if the U.S. government now decided to shield that long fought-for information behind the veil of confidentiality. The second issue we would like to discuss is the reporting threshold specified in the proposed rule. We believe this threshold should be significantly lower than the proposed $850 million. Well, according to the OECD's own estimates, this threshold would exclude 85 to 90% of all multinational corporations. While this threshold would capture the largest companies, there is no evidence that only those companies use profit shifting to avoid taxes. Furthermore, in some countries, particularly in the developing world, companies smaller than the proposed threshold can have a significant impact on government revenues. We note that related provisions have much lower or no reporting thresholds. For instance, the U.S. law requiring country-by-country reporting in the extractive sector does not mandate a threshold, and the SEC has not suggested any threshold in the proposed implementing rule. Similar laws passed in the EU and Canada have no reporting thresholds for publicly listed companies, and thresholds of 40 million euros and 40 million Canadian dollars, respectively, for private firms. We recommend that the IRS and Treasury align the U.S. threshold with those other existing initiatives, thereby ensuring that the vast majority of multinational corporations are required to report. As a global leader in transparency, the U.S. has the opportunity to establish a strong standard for country-by-country reporting. The world will be closely watching how the U.S. adopts and implements the OECD's base and erosion profit-shifting proposal. We urge you to do so in a way that maximizes the effectiveness of country-by-country reporting and enables citizens and governments here and abroad to hold multinational corporations accountable for paying the taxes that they owe. Thank you for your hard work on this important issue and for the opportunity to speak here today.
Thank you. Our next speaker is from the Global Financial Integrity, and Ms. Heather Lowe.
I feel like perhaps we need a seventh inning stretch. So thank you very much for the opportunity to testify on this globally significant topic today. My name is Heather Lowe. I am legal counsel and director of government affairs at an organization here in DC called Global Financial Integrity. We're a nonprofit research and advocacy organization that seeks to curtail the movement of illicit money around the world. We look specifically at the impacts of that on development and developing countries. I am also a steering committee member of the Financial Accountability and Corporate Transparency, or FACT Coalition, here in DC. That coalition is about 100 members strong and is a coalition of public interest organizations from a variety of different areas, from anti-corruption to debt organizations to labor. So we have small businesses in the coalition, all concerned with the lack of transparency and accountability when it comes to financial issues and corporate transparency. I was one of the primary draftsmen of the FACT submission, which you may have seen on the record, although I will say that many of the people here today weighed in on that, and we also had many other people in the coalition who also weighed in on that. So I'd like to begin by saying that we are very, very pleased to see the U.S. moving so quickly on this issue. We really welcome the administration and IRS's decision to implement what the U.S. agreed to do under its commitments in the BEPS process and not to water that down. That's really, really important. However, as I and others noted when we took part in the public consultations at the OECD level on this issue, there are certain things that can be done to make this stronger and more effective, and other things that weren't fully fleshed out by the OECD at that level, which I think deserve a little bit more attention here. To that end, I'm going to address the following topics: the types of information to be included in the form, how employees are counted, identifying numbers, the scope of subsidiaries to be included in the reporting, and the need for reports to be publicly available information. I'm not sure if you've heard that before. So starting off, the types of information to be included in the form. So the categories of information to be included that you guys have proposed are good. Where those are good, solid, in line with the OECD, and that's great. We noted in our written submission that subsection 4 we think should refer to total income paid on a cash basis in each tax jurisdiction, as opposed to in all tax jurisdictions, given that this information is supposed to be provided on a country-by-country basis. So we think that might have been a drafting error. If it's not, we'd definitely like to discuss that with you further. In addition to those categories, however, we think there are two other categories of information that should be included, and those are deferred taxes and uncertain tax positions. Those categories of information were excluded from the reporting requirements in the proposal. They were mentioned, but you guys decided not to include them. But it's our opinion that they really should be included because they are indicators of exactly the types of profit-shifting risk that the CBCR reports are intended to identify. Uncertain tax positions represent tax positions that companies believe have a less than 50% chance of withstanding an IRS challenge. The risk appetite associated with those positions is patently obvious then, and in which countries MNCs have subsidiaries with substantial transactions in this gray area is an indicator of profit-shifting risk. With respect to deferred taxes, MNCs often shift profits to other countries and then defer payment of taxes on those profits, making deferred tax information a possible indicator of profit shifting. Over time, the information can provide a marker of any changes in profit-shifting patterns, which is also really useful and valuable information in determining whether these anti-abuse measures are having the desired effect. Second, I wanted to talk about how employees are counted. To avoid creating misleading and contradictory employment data, we believe that the final rule should allow U.S. multinational groups to count as employees only those people for whom the company pays payroll, Social Security, and other employment taxes, or people for whom that would be paid were they employed by the multinational in the U.S. In other words, what the IRS already considers to be an employee. In particular, we're concerned about the treatment of independent contractors. Currently, the proposed rule states that the parent entity may count as an employee, quote, independent contractors that participate in the ordinary operating activities of a constituent entity, end quote. It offers no additional guidance on this, on the meaning of independent contractors or the concept of ordinary operating activities. This approach creates a really legal and logical inconsistency. The U.S. tax code really has a pretty detailed body of law distinguishing between who is an employee and who is an independent contractor. So the approach of suggesting that an independent contractor can be considered an employee for the purposes of counting here really introduces significant uncertainty into who the MNC is or is not including in their numbers. And that's going to be misleading as far as, looking at, where the company actually has significant operations and profit at the same time. So let's look into that a little bit more. Consider a situation in which a parent company hired independent contractors to its accounting department for temporary help, like maybe 9 months of help. Right? Those independent contractors worked on preparing several subsidiaries' accounting and tax filings. Given that the accounting would probably be considered ordinary operating activity of each of the subsidiaries, the parent could conceivably claim that these independent contractors were employees of those subsidiaries, which they clearly are not. Opening the door to this sort of distortion, artificially inflating employment numbers for subsidiaries, creates this misleading picture of offshore operations. That's entirely what we're trying to avoid with this form. In addition, one very common tax avoidance tactic is for multinationals to form shell entities in tax havens and then hire corporate service providers, law firms, financial institutions, Mossack Fonseca, to provide the shell entities with presidents, managers, or other officers. These people are on the paper and they have absolutely no activities. They may be on the officers or on the boards of thousands of companies at once. Allowing the parent entity to treat those nominee individuals as employees would not only artificially inflate the employment figures in the tax haven, but completely, again, distort the meaning of the word employee. So that's an issue as well that we'd like to see addressed. I'm going to move on now to identifying numbers, just really briefly. The proposal states that TINs will be required for each MNC parent and entity subject to reporting. That, of course, makes total sense, right? Especially from the IRS's standpoint. We've also recommended, however, that the final rule require each parent entity to provide a legal entity identifier, or LEI number, for itself and its constituent entities, using this new international system of identifying business entities. We've provided additional detail about this system in our written submission, including information about the active involvement of Treasury, the Fed, and other parts of the U.S. government in the creation of the system and its implementation in other parts of government currently. Next, I'm just going to talk briefly about the scope of subsidiaries to be included in the reporting. I think my colleague from Oxfam is going to be talking about this in greater detail, but it's a really important issue, and I wanted to make sure to also raise it today. We're very concerned about the proposal to limit reporting to consolidated entities alone. We're of the strong opinion that reporting should cover all entities that would be accounted for under the equity method, which would provide a much more complete picture of the corporate group and provide for a much more accurate picture of where profit shifting may be occurring. A major point of this entire requirement is to help identify where one should be looking for aggressive or abusive transfer pricing. And the more complete the information is to guide that assessment, the more appropriate and therefore less burdensome the inquiries from tax authorities will be. Finally, I wanted to also talk about the need for the reports to be publicly available information. Country-by-country reporting has the potential to be a game-changing measure in the fight against profit shifting by multinational companies. This is the most important step that can be taken to turn that potential into reality is for CBCR information to be made publicly available. Ideally, as data published by the MNCs on their website, as has been proposed in the European Union. Why is this so critical? Despite being one of the most well-resourced tax authorities in the world, the U.S. cannot on its own address this problem, which has cost the U.S. an estimated $111 billion in corporate tax revenue from 1983 to 2012. The IRS already has all of this information that would be collected under the CBCR form and more for every US-based multinational from its CFC filings. And yet profit shifting out of the US has grown substantially in recent years. You'll know better than I why we haven't gotten on top of the profit shifting, but part of the problem is that it takes a number of countries acting in concert to address it. We can't do this alone. I have no doubt that another part of the problem is that the IRS has a great deal of increasing responsibility. Oh,
I have to stop you. I'm sorry, but
Okay.
thank you for your comments.
No problem. Thank you.
Our next speaker is with Oxfam America, Tatu Ilunga.
On behalf of Oxfam America, I would like to thank the U.S. Treasury and the Internal Revenue Service for the opportunity to express our strong support to the United States global commitment to require country-by-country reporting by U.S. multinationals and present our comments to the proposed rule. My name is Tatu Ilunga, and I am the Senior Policy Advisor on Tax Issues at Oxfam. along with our FACT coalition partners, Oxfam seeks an honest and fair international tax system, greater transparency in corporate tax payment and ownership. Also, policies that contribute to reduce inequality, that undermines our social fabric and hinder our economic growth. I'd like to begin my statement by making a reference to the effect of profit shifting on corporate tax base in the US and beyond, a paper that estimates that profit shifting by multinational corporations is likely to cost the US government approximately $111 billion in corporate tax revenue each year. Also, it is estimated that similar practices by multinational corporations worldwide lead to a loss of $100 billion each year for developing countries. Profit shifting by multinationals erode the US tax base, negatively impact US and state budgets, increases the deficit, and limits funds available for commercially important services like producing an educated workforce, maintaining America's infrastructure, and financing US courts and law enforcement. It also contributes significantly to an uneven playing field for America's small businesses. Profit shifting drains money out of developing countries the same way, undercutting US foreign aid, increasing global poverty, and contributing to economic instability. The damage done to American citizens and people living in poor countries by these corporate tax practices are inevitably two sides of the same coin. Oxfam strongly supports the need for a CBC reporting as it will bring more transparency. To make this new rule more effective, we respectively would like to offer or comment on the need for CBC reports to be publicly available, on the 50% threshold required for constituent entities to be included in CBC reporting, and on the importance for sharing CBC information through the multilateral exchange agreement created for that purpose. Today, no one in the US has reliable country-by-country information on where US multinationals operate, how many employees they have, the size of their capital investment, the amount of their profit or losses, or the taxes they pay. The information to be collected by CBC reports will, for the first time, provide accurate, timely economic, business, and tax information that could play an invaluable role in designing effective and efficient US policy. The proposed rule does not require these companies to make this information public. Instead, it will make the information confidential to the IRS and, in time, under specific circumstances, to tax authorities in foreign jurisdictions. We strongly recommend that CBC report be made publicly available either by the US government or by the reporting entity as a statutory requirement. Given the massive amount of loss of revenue for both the US and developing countries, there is a substantial American and global public interest in ensuring that CBC report information is available to as many different types of stakeholders as possible. That public interest far more outweighs any perceived need to protect what some may say is commercially sensitive information. It is precisely the lack of transparency that currently characterizes this information that has prevented lawmakers and other stakeholders from being able to see the development and effects of aggressive profit shifting over time and identifies ways to address it. Furthermore, we believe that making that information public could serve as a deterrent for multinationals to use aggressive tax planning. Second, under the proposed rule, a US parent entity may exclude from its CBC reports any information related to a constituent entity in which it has 50% or less ownership interests, even if it includes income for that entity in its financial statement. It is unclear to us why the proposed rule drew the line on reporting at 50% instead of applying the equity method of 20%. In the final rule, if the final rule were to require parent entities to include in their CBC report constituent entities that are accounted for under the equity method, meaning entities in which the parent entity has directly or indirectly at least a 20% equity interest, the final rule would provide a much more comprehensive view of the multinational group business and profit-shifting practices. Under US GAAP, a 20% or greater equity interest triggers a presumption that the investor has the ability to exercise significant influence over the entity, and that entity should be accounted for in the investor financial statement, absent of predominant evidence that such control does exist. In addition to a vast majority of countries, of which some foreign multinationals operate in the US, uses the IRS that requires accounting for constituent entities in a manner that is similar to the GAAP's equity method. To ensure US CBC reporting is comparable to the reporting that will be provided globally, respectively recommend that the final rule require US parent entities to report the information for all its constituent entities accounted for under the equity method. Finally, another important issue involves the manner in which the US intends to exchange information with other countries. The explanatory text of the proposed rule contains language that indicates an intention to limit the permissible uses of exchange data even beyond the constraint contained in existing information exchange agreements, prohibiting the disclosure of information for any non-tax purposes. We believe that this is too restrictive and recommend using the international agreement established for that purpose, referenced here as MCAA. We understand that the US will not sign the MCAA and will rather enter into bilateral agreement with appropriate countries that have adopted country-by-country reporting provision, have appropriate safeguards and infrastructure in place, and with respect to which the US has income tax treaty or treaty information agreement in effect. While the US has a very comprehensive tax treaty network, it excludes several developing countries, many of which are honorable in respect for confidentiality and protection of taxpayer information, and above all, are most in need of CBC information so that they can intelligently direct their limited resources in identifying and curbing base erosion and profit-shifting behaviors. Furthermore, we believe that the US current plan to exchange CBC information to its network of bilateral tax agreement instead of the international agreement developed for that purpose comes with additional costs, delays, information restrictions that will have potential negative impact on developing countries' access to the information. We therefore respectfully ask the US to rather than disregard the proposal to use the international process for sharing CBC information. On behalf of Oxfam, I want to thank you for the opportunity for speaking with you today. Thank you.
Thank you for your comments. Our next speaker is representing the International Alliance for Principal Taxation, Mary Bennett.
Well, good morning, and thank you. Yeah, I'm Mary Bennett. I'm from Baker McKenzie in Washington, and I'm speaking today on behalf of the International Alliance for Principal Taxation, which is a group of U.S. and non-U.S. based multinational businesses from a large number of different sectors whose aim is to promote international tax rules that avoid double taxation and provide predictable treatment for businesses operating internationally. And we appreciate the opportunity to comment on several aspects of the regs today. Let me start with the effective date. In that connection, we certainly welcome recent indications that the IRS may be willing to accept voluntary filings for U.S. Multinational groups for parent entity years beginning on or after January 1, 2016. To eliminate the gap period, we suggest that this be allowed, if done, without regard to the date on which taxable years of the group's constituent entities begin. Our written comments provided an analysis for why the IRS would be authorized in the final regs to require CBC reporting for U.S. M&E groups for years beginning on or after January 1, 2016, and we suggest that you might want to revisit that analysis if you can't reach international consensus that voluntarily filed 2016 reports will prevent other countries from demanding secondary filings. Regarding the filing deadline, the OECD purposely gave taxpayers up to 12 months after the end of the reporting year to file the report, in particular because they understood that the so-called bottom-up data the groups might want to use to prepare their reports, such as local statutory accounts, were often not available until many months after the end of the reporting year. So we would strongly urge the U.S. to try to conform to that by setting the filing deadline 12 months after the end of the reporting year, either across the board or based on the availability of an automatic extension of time to file the report. In connection with the definition of the U.S. M&E group and constituent entity in the regulations, we note there's a potential difference with the OECD definition of constituent entity to the extent that the latter includes any entities required to be included in consolidated financials, and the U.S. definition appears to exclude any non-majority owned entities. So to ensure that a U.S. M&E group's U.S. filing will be recognized by other countries as meeting the OECD requirements, we recommend that U.S. M&E groups be allowed to include all entities meeting the OECD definition of constituent entity in their report. And we further recommend that the regulations clarify that each data element in the report should be based on the constituent entities resident in the particular country, whether the group uses the U.S. or the OECD definition of constituent entity. The regulations currently imply that groups that prepare consolidated financial statements are not allowed to use bottom-up data sources. And the regulations should, we think, be amended to clarify that U.S. M&E groups are allowed to use either top-down or bottom-up data sources, whether they prepare group-wide consolidated financial statements or not. The regulations also need, I think, to be amended to clarify that the data included in the CBC report will be based on a single group-wide annual accounting period if the group uses top-down data, and if the group uses bottom-up data, the report will be based on data for the constituent entities' respective annual accounting periods that end with or within the ultimate parent's taxable year. The regulation currently sets the $850 million of group-wide revenue as the threshold for $850 million of group-wide revenue as the threshold for requiring a CBC report. And here again, in order to ensure that the U.S. dollar threshold is linked to the OECD's 750 million euro threshold in a way that's recognized as valid by other countries, we recommend that agreement be reached at the OECD on a methodology, a common methodology for determining the non-euro equivalent of the OECD's euro threshold, and that the regulations be ultimately amended to follow that methodology. And one suggestion we made in our written comments was to set the local currency threshold as equal to the equivalent of 750 million euros converted to the local currency at the exchange rate applicable on the last day of the M&E Group's annual accounting period immediately preceding the annual accounting period for which the report would be required. Finally, as a general point, we recommend that the regulations conform as much as possible with the international standards set at the OECD, and I think for the most part they've done an excellent job of doing that, and also that the U.S. take necessary steps to ensure a number of things. One, we've heard just now that we have widespread automatic exchange of information agreements in place on a timely basis so that groups will know that their reports can be filed with shared with as many countries where they operate as possible. That the IRS will publicize the jurisdictions with which those agreements are in place. That the IRS will provide a mechanism for reporting suspected cases of violations by foreign jurisdictions of their obligations of confidentiality or use of the CBC data, and that international agreement is reached on aspects of countries' secondary reporting requirements so that those are consistent across the world. That's all I have, and thank you very much for your attention.
Thank you. Our last speaker today is with Ranty Corporation, Timothy Lose. Okay, I guess he is not here today. Thank you everyone for your comments. Would anybody else like to speak that was not on the list?
For lunch.
Well, thank you everyone for coming.
Open for the hearing.